Good news for the GDP. The number was good. Inflation numbers were muted, so that helped a little bit, but still open 7-1, declining to advancing stocks. And that's because earnings and to a certain extent revenues are a little disappointing today. Take a look at the sectors. You can see this. This is not macro. This is earnings related here. Consumer discretionary. You got Amazon and Mattel were disappointing. And the communications, you got Google and Netflix disappointing. Facebook's down 2-3%. Tech, you got Western Digital disappointing. That's down 15%. Some of the semis are down 2 or 3%. Consumer staples holding up a little bit better. General Mills and Walgreens, Walmart were up earlier, but again, that's an outlier here. This is a lot about revenue disappointment. I was kind of surprised to see some of these misses today. So Mattel, Mohawk was just a mess. Colgate missed. AK Steel, the EBITDA was light. Amazon, Alphabet, Western Digital revenues were on the light side as well. So it's been a very difficult day overall. If you want the poster child, the guys mentioned Mohawk. They had just about everything you want in their report. Of course, this is a big flooring company, but the guidance was below expectations. They talked about input cost inflation and lower demand and a lot of competition and less pricing power, and they just went on and on. The only thing missing was locusts descending on the factories. They just had a whole kitchen sink quarter there. If you take a look at Mohawk, it's just like all of these home building and home related companies, Whirlpool and the home builders, all been down dramatically in the last several months. One thing that might help, maybe, are buybacks. We got a nice announcement from Schwab, $1 billion buyback. That includes some prior authorization. That buyback's about 2% of the shares outstanding. Mohawk is buying back 5 to 6% of the shares outstanding. That is a big, big buyback. Investors Bancorp, very small. New Jersey Bank, 10% buyback announcement, 10% of the shares essentially. That's huge. So the question is whether buybacks, now that we're getting out of earnings season, will be a source of support. We've been telling you there have been huge amounts of purchases and announcements. We've got about 646 repurchased in the last year. That's 12 months. But there's estimates of as high as $350 billion in dry powder. These are authorized but not yet executed. That's a lot of money out there that potentially could support the market. One other thing that's odd this week, the fund flows, which I watch very carefully, are a little bit strange. We had notable inflows into stock ETFs, $8 billion, very large inflows into SPY, the largest S&P 500 fund, and the Russell 2000 funds. These are plain vanilla funds. Mutual funds, however, had some modest outflows. Remember, the mutual funds are bigger than the ETF business. Modest outflows, and also notable outflows in some of the taxable bond funds, no matter where you are, ETFs or mutual funds. So why do we get such notable inflows into stock funds? It's possible a lot of people were coming in and buying the shares to short them. It's possible. I'd like to look a little bit more into that and find out, but it's a curious number overall. Right now, we're lifting a little bit, 200 points to the downside on the Dow.